Hello and welcome. My name is Wayne Bishop. I am the CEO of King of Shaxton Asset Management in London. And I'd like to welcome you to this webinar, ESG in the New Economy, which we are doing at the end of April 2020. So since the end of February, the global economy and particularly the global equity and bond markets have been rocked by the coronavirus epidemic. And that has a significant bearing on what we really want to talk about today, about how ESG has conducted itself and how ESG has performed during this difficult time. Should you have any further questions afterwards, please feel free to contact Peter Thompson, whose details will be at the end of this presentation. So here's the disclaimer. If this is your bag, knock yourself out and have a good read. In the meantime, just very quickly, who are King & Shaxton and who are King & Shaxton Ethical Investing? Well, King & Shaxton is an ancient discount house. We can trace our roots back to 1866. You will still even find us on the DMO website as one of the few non-bank counterparties to the Bank of England. But in addition to that, we are part of a large global group, Phillip Capital. We have about 4,000 people across the world, over 16 different countries. King & Shaxton Ethical Investing, which is King & Shaxton Asset Management in the UK, specialises in one thing: ethical investing. So we run bespoke or model portfolios with a very strong ethical stance. We're used to clients ranging from mid-green to dark green, and our whole ethos is just ethical. We do not do anything in the conventional world. Not only is this what we do, it is also who we are. In other words, every member of the team has a strong ethical conviction. I myself am very convicted in the way we run money, and it is very personal to us. So this is not just a day job. This is not us running off some ESG metric, trying to do some quantified system. This is actually something we are personally very passionate about. And we think that's important because ethical investors will obviously, by their very nature, whether they're into impact or just into lighter green, are naturally interested in what is going on in their portfolio, far more interested, say, than your conventional investors. So they will want to know that their investments are doing well, but they will also want to know that the investments are meeting their non-financial obligations. It's important to meet the financial obligations. It's important to still invest with common sense and to seek investments that are profitable and have a long-term return, and that is still at the forefront of what we do. But at the same time, it is to understand that this is what we're doing is what clients want, that the companies are intentional or at least moving very much in the right direction to clients. In other words, not just greenwash, not just ticking boxes, but actually also the kind of investments that we know will make clients happy to have in their portfolio, and therefore we hope will result in happy financial advisors as well as happy clients. So even before the corona crisis, we'd had a few years of what I would call good outperformance of ESG versus traditional. And a lot of that has come down to what I consider the main driver being the old versus the new economy. And one sector in particular that I'm going to highlight is fossil fuels. If you go back 10 years, fossil fuels were regarded as sort of best of class acceptable. So, in other words, you could invest in fossil fuel companies, say, drilling in the North Sea, but you had to avoid the areas where perhaps there's more controversy, say the Niger Delta, for example. And so companies like BP, after their crisis in the Macondo well, were excluded. Companies like Shell would have always been excluded. But you would have had BG Group in the UK, you would have had Statoil. Um, Over time, the attitude towards fossil fuels has changed quite substantially to the point now where it is almost universally excluded. And in fact, our portfolios are pretty much fossil fuel free. In other words, there is no oil companies in there, very limited in the way gas is, and it's normally an incidental business rather than being a mainline business. So that has been a substantial area of change. Why does that matter? Well, it makes up about 15% of the FTSE and a large number of the global indices, not just that, not just the UK indices. And so what you have here is one sector that has lagged for about 5 or 6 years and therefore has been a contributor to, say, the underperformance of conventional versus ESG investing. We can say the similar about large banks. We can say similar about mining as well. So there's been various sectors that have been key drivers in the outperformance over the years. Though I'd love to say ethical is magic, it's not quite that. But also the point I alluded to before, the maturity of companies in this sector has also had a big change. So in other words, 10, 15 years ago, renewable energy would have meant the likes of Vestas Wind Systems, Gamesa, etc., where you are making the wind turbine. You would have looked at the solar companies, the German ones back then, who have subsequently mostly gone bust, but they were the people making the solar panels. These were the people developing the technology, and this technology was going to start taking over. Nowadays, you look at it and you have a lot of yield cos. What is a yield co? Well, they're the companies that basically own and operate the asset and make their money basically just by sunshine and meter turning, or wind blowing and meter turning, or gas being produced for anaerobic digestion and meter turning. And they often buy the assets in turnkey solutions and then basically own and operate, and they offer a decent yield. There are some issues because the electricity price has come down as a result of this, and on a day like today, with 60% of our energy being renewable, energy is very cheap. But these are now mean that basically you have an array of investments available that you didn't have, say, 5 years ago. So depending upon the income growth profile or what you're looking at, you can have yield cos, you can have yield cos and development cos, or the manufacturers, or you can have a combination of both. But your whole investment universe is substantially larger than it was before. And this is really representing what is the new economy. If I'd have said 10 years ago that we'd have days where more than half our energy is coming from renewable energy and a lot of that is now increasingly subsidy free, people would have said you're balmy. But it is now the new reality. And it is now not just taken over in the UK, it is taken over in Texas and other places. This has happened. The new economy is taking off. We're seeing it now in mobility, particularly around electric cars. We're seeing it around food. So what we're seeing here is perhaps a change in the way that whether we're looking at the old economy or the new economy, where we are seeing growth. And I think this is particularly important when we look at how ESG is going to continue to perform. So we now know roughly what has been the key drivers before in the past, what was excluded, and therefore why we've outperformed, because at the end of the day, it's the underlying investments that dominate performance. But we now have to look at how it's going to go forward in the future. And I just want to illustrate that by looking at the next slide. So what we have here is the performance of some of our models versus the conventional UK benchmarks. And we can see sort of since 2015, which would have been sort of towards the end of the financial crisis, that we have seen good outperformance from both the cautious all the way through to the adventurous. Now, some of this is down to the fact that these portfolios are slightly more global. But when we say more global, one of the biggest drivers of global performance has been the FANGs. Now, the FANGs, by that I mean Facebook, Amazon, Apple, and Netflix and Google, or as it's known as Alphabet. These stocks have been the real key drivers of the growth of global equity indices, particularly because these have been the great global growth stocks. In fact, you strip these out and the performance looks vastly different. Now, the problem is that practically all of these stocks have some serious ethical issue. I think really with the exception of Microsoft, none of the others really would make much grade from an ethical perspective. The issues will be around taxation, labour practices, and other kinds of things. So the funds we have that invest globally are not invested in the FANGs. We have avoided the FANGs, and yet despite that the fact that the FANGs have driven performance, these funds have also continued to perform very well. So I think this bodes particularly well when we look at how global performance has happened in the past. It has happened despite the fact that we are not invested in the FANGs, and it shows, I think, that there is still good underlying interest in a lot of the kind of investments that these funds are invested in. This also is reflected in the volatility numbers, because we can see over the period of time as well that the volatility has been low. So not only is the performance better, but the volatility is low, partly because you are not invested in particularly volatile sectors such as oil and gas again. So going back over the past data, just before we look at the future and our outlook, we are seeing that really we've had 5 years of very good outperformance based upon the sectors that you invest in and the sectors you're not invested in, and with that also some lower volatility. So it's given us a good basis to really look at the future. Bond markets have always presented some various interesting ethical investments. They've been able to access areas that we can't access via equities. In particular, I think of the old railway bonds, and before we had the social housing rights, the social housing bonds. At the moment, the whole sector, whether we're looking at conventional fixed income with long and short duration, whether we're looking at floating rate notes, or whether we're looking at index linked paper, all have something interesting at the moment. I think one of the big elephants in the room for fixed income has been obviously the prices have risen substantially, yields are at a new all-time low, but they perhaps have not performed as well as people had expected. partly because with the beginning of the crisis, the biggest issue was liquidity. In other words, for the first couple of weeks, people just wanted to have cash. You didn't want to lock money up, partly because if you had a business or an operation, you needed to know that you had the cash on hand to deliver. I think now that perhaps some of that uncertainty has left the market and we've got some kind of plan, we've got some idea how stimulus works, and people are getting a little bit more of a handle on maybe how long this crisis is going to last. Some money is returning to various places, and this is where it gets a little bit interesting. With conventional fixed income, the big growth area obviously has been green bonds. We think green bonds do provide an exciting opportunity going forward in the future. At the moment, in our view, with fixed income, generally there's not a great deal of meat on the bones at the moment, so perhaps it's not particularly interesting right here, right now. But I'm sure there will be a great deal more issuance out there, and for people who must be in this sector or where it is required for asset allocation purposes, I think it's going to remain an interesting area, and certainly one that I think will continue to grow and eventually perhaps even dominate the bond market. I think that these requirements are just getting more and more interesting. Alongside that, you have some of the railway bonds, and railways obviously are in an interesting place after this crisis because, on the one hand, many of them have got some implicit or explicit state guarantee, depending on which one you look at. On the other hand, they've seen obviously their demand themselves slump, and railways are at the front or at the forefront of what's going on here with the coronavirus, because obviously their revenue has substantially reduced as mobility is substantially reduced. Perhaps slightly further out and more interestingly from our point of view, but certainly a great deal riskier, has been areas such as microfinance. Microfinance suffered immensely in this crisis. This is loans to small enterprises and individuals on in emerging markets, basically doing small business operations. Although it has traditionally got a very low default rate, these are people who will have been impacted very heavily by the crisis. Therefore, that's one bad factor. And then, of course, a lot of this is in emerging market currencies that have also suffered immensely, particularly against the US dollar, into this crisis. But at longer term, there may be some interesting returns here if you've got a long term view and you take a very risk conscious view and make small investments in this area. There are some opportunities presenting themselves, but that is much, much higher risk, I would stress, but certainly something we're considering at the moment. The big issue with any kind of fixed income investment, particularly the conventional bonds, is inflation over the long term. And here we've got an interesting scenario with a very strong two-way pull. On the one hand, the absolutely unprecedented amounts of monetary and fiscal stimulus will eventually hit the economy. And I think one of the biggest differences, say, between the stimulus we have seen this time around to, say, the stimulus after the financial crisis is that this stimulus has gone directly into the economy. Whereas in the financial crash, a lot of the stimulus just went straight into the financial system and therefore inflated asset prices. This stimulus is actually finding its way out onto the streets, into real people's pockets, and therefore, as I said, into the real economy. And therefore, we do think that the effects will be very different. Whereas the other stimulus didn't seem to have a great deal of effect on the normal economy, on normal growth rates, I think you'll get a much better return or much better bang for your buck, is a way of putting it, on this stimulus actually touching the real economy, and therefore there is perhaps potential to see a little bit more inflation come as a result of that. The counter argument is that, of course, the oil price, which is another huge driver of inflation on the cost push side, is now substantially lower, down at $19 a barrel as I'm speaking at the moment, and that's going to have a big impact on inflation as well in the other direction. So we've got a big two-way pull on inflation. I think in the very short term, we don't see immediate inflationary problems as the economy slows down. In fact, people might even talk deflation in the very short term. But in the longer term, this stimulus will eventually hit. So really, our short-term scenarios, low inflation. Our longer-term scenarios, we might find growth almost being out of hand or being very strong into the sort of first half of 2021, depending on how this crisis pans out. And of course, that is the big question: does this crisis blow away in the next sort of 3 to 6 weeks, and by the end of September, we're thinking, well, that's all gone, or is it one of these things that is going to be consistently recurring? We're hearing all kinds of stories from different people, and even people are saying it may be all good right now, but this crisis will come back in the winter. So there's a lot of two-way pull, and this is the big factor. So there are interesting bond opportunities, but right here, right now, it is probably the least exciting area, and more about return of capital than return on capital. Well, property was a sector that was certainly already interesting and suffering even before this crisis hit. There have been issues with one or two property funds and liquidity. And not only that, but the Mike Ashley effect, as we call it, had already started to have an impact on a lot of the retail property sector and was beginning to also sort of cause concerns around some of the office property sector as well. From our point of view, we have actually excluded or not had a great deal of investment in conventional commercial property. In fact, in our direct equity portfolio and our bespoke portfolios, exposure here was already zero because we already had some serious investment concerns. In fact, in those products, our focus has been much more ethical. In fact, we were looking at both medical properties as one area, social housing, and affordable rental rights. And there was enough there to make up the exposure without having anything in conventional office or conventional retail properties. In the fund portfolio, our exposure has been very limited to conventional property, and in both of them, we have favoured a little bit more in infrastructure, if you like, rather than property. But one of the main issues has been is that this crisis has only exacerbated or accelerated the trend. Trend number one, retail was moving increasingly online. The large store format was rapidly going out of fashion. Malls were changing, and already you were seeing anywhere that was sort of B or C rated, if you like, or less than prime retail was already beginning to suffer. And I think this trend is probably only going to make that even harder and even worse. So we don't see much potential for that area in itself to recover. There will be some kind of stabilisation, but we think already the assumption that you'd have ever increasing rents on these properties, which is what a lot of the funds relied on, is already gone, and there are going to be some casualties here. And this will have effects in banking as well as in the retail property sector itself. On the other front, it's the other thing that has probably changed very rapidly is the new office reality. We were already used to seeing the disruptors in the forms of WeWork, etc., coming in and offering a new kind of style of office and a new kind of serviced office. But now I think the question is going to be, what is the future of the office? This crisis, I've already been working from home for 6 weeks. I've got used to it. And although we're a regulated entity, and being a regulated entity, it was mandatory that we could carry on business regardless of what went on. We had all our contingency in place. I'm absolutely delighted that everything has worked so well. And in fact, to be honest, I found working from home far easier than I thought it would be. I found actually communication is much better. Why? Because it is far more intentional. In other words, when I Zoom people, we're Zooming with each other with a real reason rather than just say general office chit chat. So it's meant that we're able to communicate with each other far more quickly. We can keep each other up on Zoom if you like, so we don't even miss seeing each other. So I think that there has been a totally different reality for offices. And I think come back from the crisis, I think everybody would be delighted to go to the office for a few days, but I think after that, people will be asking serious questions about productivity. There was a myth that working from home was a sort of detriment to productivity, but I think people like myself who are perhaps used to commuting, say, 30 minutes each way a day, and have realised you found an extra hour a day already. And the fact that probably we don't have to sort of be smart all the time means that we're saving even more time and we're able to work at more convenient intervals in the day. And therefore, I think there will be a whole new reality come the end of this crisis, and we have actually catalyzed that. So we are very wary about conventional property. As I said, we have focused on social housing. Why? Because the demand for social housing is strong and ever increasing. And it is always a positive because at the end of the day, this social housing, a lot of the funds, their focus is not so much what we'd call a man in a string vest, but more so people who have needs, additional needs. And therefore, from a social point of view, it's cutting the bill for social services as well as actually providing a decent investment basis for a lot of people. And we've been pleased with the performance of some of those funds over this crisis. On the other hand, the rental sector, we're seeing perhaps a little bit more pressure because of the development, but we understand the social need for good, affordable housing is very, very strong. It's a big cost when people are spending 50% plus of their wages on property and living. That is money that is not going into consumption, money that is not going into future savings. And therefore, we know that this is an area that the government wants to hit hard on. It's an area that's going to have a significant impact on votes at the next election. So we still see developments there as well. So there and in infrastructure where we see the need because some of this stuff has been desperately overdue and it is an easy place to put people into an economy right now. We still feel that those areas will remain very interesting. Although infrastructure may appear expensive, we don't see it getting much cheaper in the future. We do see the biggest risks around the conventional sector. So from an ethical ESG perspective, we feel that the future is probably more positive than, say, the conventional at the moment. Then to equities, and I'm going to do this in two parts. I'm going to address the negative and the positive area. The negative area being where negative screens have been applied, because as I've already mentioned, this I think has been one of the key drivers of, say, ethical ESG performance versus the conventional market over the last few years, and even into this crisis has also been a key driver. Obviously, we have the picture there of the oil wells, and that has been a substantial area of where we've seen this difference, where basically oil has continually underperformed. And the question is what is the outlook for oil now? Well, I think we saw some clues last week, because when OPEC and Russia finally ended their spat in the USA, and we sort of started to see suddenly supply restrictions on oil again, the oil market hardly reacted. It sort of rallied for a little bit, but then very quickly started to come back down again. Why? Because it hasn't really addressed the issue of supply, i.e., we're continuing to produce far more oil than we're using. And whilst at the moment it's been going into storage, that cannot continue forever. And therefore, the speed at which we come out of the crisis is going to have a big impact on the future of oil. And at the moment, that is looking slightly more delayed in expectations than perhaps we were a little while ago. And therefore, at the moment, the oil price continues to suffer. But even as we sort of resume to normal, people start flying again and people start driving again. Are we going to see the same return? Well, longer term, we don't think so. We think the electric car is here to stay, and we see that being a substantial sort of changer in the next 4 or 5 years. I would say electric cars at the moment probably will exponentially rise, and that will be at the cost of oil. Plastics obviously are very out of fashion now. David Attenborough has had a huge impact on our attitude towards that with his documentaries, and therefore that again is another area where we're going to see substantial change. Therefore, I don't see oil snapping back as quickly as before. Similarly with banking, although banking is an area where they've perhaps seen a far better flows from their trading, on the other side of the coin, right now interest rates have gone back down. That's going to affect their interest rate margins. So therefore, the outlook for banks at the moment is perhaps a little less certain as well. So whereas normally you'd say, is there going to be a huge snapback? Are we going to see, as we recover, some of the sort of sectors that are much more economically sensitive, like oil, mining, banking, suddenly rally again? I'm not so convinced in two or three of these cases. Mining probably will rally a little bit more, but again, coal won't benefit from that. But some of the other sectors, we're not as convinced that we're going to see such a rapid snapback. And oil, I think, I often relate to it now as the new British pound, i.e., it just always goes down. And I think at the moment, the cyclical nature of oil, but the structural nature of oil are both in very, very difficult places, and I don't see it coming out of either of these. And I think that is going to continue to be a drag on the market, and therefore, from the negative screen perspective, is going to continue to impact the sort of outperformance of SRA, say, versus conventionally investing. This impact area. And here we've got the pictures of what I would say are two of the more important positive impact areas. Renewable energy. Well, renewable energy continues to be on the march around the world. It is not just in the UK, but everywhere we're seeing these substantial increase in wind farms, substantial increases in solar. We're seeing solar funds really take off in the US, and there was an interesting piece in the FT the other day about how solar is really taking off in Texas, of all places, and in fact powering some of the oil industry right now. So this is a trend that we think is really, really taking off and is going to continue. It is a trend that is also becoming far more efficient, far more mature, and behaving like a mature industry. So price, production, efficiency becoming very, very important in this area. So that area we think is going to continue to outperform. The biggest risk in this area is perhaps the energy price. The electricity price in the UK has fallen substantially. A day like today, for example, about 60% of our energy is from wind and solar right now. It's sunny and windy outside, so we're seeing some particularly normal days. And of course, this is incredibly cheap energy now that everything is up and running and beginning to be increasingly subsidy free as well. So the dial has really moved as far as renewable energy goes, and it will continue to be what I think an efficiency function. The area where we see the next really big change, as you can see there's the picture of the Tesla car. I know from my own experience living in northeast London, A year or so ago, you might see one or two. Now I see loads of Tesla cars when I walk around my neighbourhood, and I don't hear them creeping up on me. We see nodes and Nissan Leafs. Okay, this is metropolitan life. Perhaps it's easy here, but we are seeing the infrastructure being rolled out around the country that people can book themselves in and get their car charged while they're driving up the motorway. And therefore, I think there will be a substantial behavioural change. At the same time, there is generational change in attitude towards cars anyway. Our children or my children's attitude towards cars is totally different to mine. I was in a car on my 17th birthday learning to drive. My kids didn't bother. They don't need to drive. They know how to use Uber. These whole changes in trends are quite substantial. And I think this is therefore where we're going to see some of these positive areas continue to develop. People now are looking at vegan food. That's another big area of growth. I haven't really want to touch too much on it right now, but actually how food is sourced, and that is becoming far more ethical, both in the way that we're looking at organic fertilizers, but also we're looking at the carbon footprint of what we eat. In terms of work lifestyle, sort of things like childcare for working mothers is another area where we're seeing a lot of positive investments. So water resources, pollution, waste control, all these areas are very important. And I think one of the biggest areas where I think I want to say sometimes people have a bit of a misconception is people think it's the millennials driving this. The thing is, it isn't. I think it's actually Generation X, my generation, the sort of 35 to 55-year-olds who now have the economic power. The people who now have the savings, the people whose kids are out of education and no longer sort of draining their finances as much, the people who are inheriting money. These are the people who are actually turning the dial. We are the people who saw Sting in the rainforest when we were kids. We're worried about the ozone layer as it was back then and global warming. And we understand these issues and we take these issues perhaps a little bit more seriously. But we are the people with the money. We are the people pushing the dials. It may be our kids making the noise right now about environmental issues, but it is the real money that is being moved by this generation. And I think that is actually one of the things I think people miss. It is not a millennial thing. Yes, they are going to be far more conscious, but it is their parents who have the money, and it is their parents who are making the investment decisions. And when we see the investments coming in, that is where we're seeing the money coming in from. And I think that is why another reason I think that we have a stronger interest and stronger inflows into this market right now. So we come now to questions. So I'm going to look at some of the questions that we've been asked and see what we can answer right now. Well, the first question here is, will the COVID-19 outbreak impact the drive into ESG assets? Strangely, I think it will, but at the moment, obviously, there's a great deal of uncertainty. We've seen inflows, ironically, in the last few weeks. I think people taking advantage of the market being down to move money across. It could also be weird because of the fact it's the beginning of a new tax year. But I think actually, yes, we've seen some inflows during this time, and I think it's perhaps down to being the ethical side of it. But I also think people are using this opportunity in the weak markets to have a dib and just get themselves into the market. The strangest thing is that really I know looking at the end of March numbers, we were barely down. So in other words, although we sort of lost about, I think it was about 10% in the market, which was far better than where the market had been. Sort of over the quarter, we'd seen good inflows coming in that basically sort of mitigated the sort of effect of the market. So yes, we know that there are still people looking at this, and I think as the questions rise, people will ask questions, and again, if people don't think we're going to see that big rally in the conventional side, then I think we will see more interest in this sector. So I don't think it will have a negative impact. If anything, I think it will have a positive impact. Another question is, what effect will the oil and gas have on the overall markets? Can you explain the term stranded assets? Well, I haven't really focused on stranded assets in the talk, but I think it is a very important area to look at. Stranded assets are assets that are on a balance sheet at the moment but may never be used. And one of the biggest areas in this is oil reserves. Oil companies have a substantial amount of oil reserves, and some people look at the ones around the Arctic basin in particular and say they will never be used, and therefore those assets will become stranded, i.e. they'll be assets they'll never be able to use and may eventually end up being written down one day. I think this is an important area, and I think it is an important reason for concern in that sector going forward anyway. The FCA were quite clear a couple of years ago. We were all down at their building, and they were talking about the fact you have to factor in climate change now into long-term investments. And I think this is one of the key areas. And I think it's a very big area of the market. It's a very substantial part of the market. but it is an area that I think is particularly at risk at the moment. So yes, I think oil and gas will be an area of substantial impact, and yes, it's one we have to be very careful about. Do you see a rise in green bond investing as people fly towards debt away from equities? Um, I think what we saw was people fly away from all investments to cash. And I think people, when they go back, are probably going back in the same way. I think green bonds, without any movement in the underlying markets, will continue to grow. I think people are now used to issuing them. I think that there is an increasing market for them, and I think that as demand for the ethical funds rises versus, say, demand for convention, in other words, ethical becomes an increasingly larger part of the pie. So the bond markets will adapt, and increasingly people will want bonds to have a particular green focus. So I think that will happen naturally away from the fact that whether more money goes into bonds or less money goes into bonds. I don't think people have necessarily just fled equities. I just think they fled everything for cash. And I think when they're going back with equities, longer term looking much better value, depending upon your view of how things pan out over the next few months. I think the money will probably head back towards equities anyway. The next question here: what impacts have you seen? What opportunities have you seen impacting your portfolio, both positive and negative? Well, I think I covered that in what we're saying to some extent. So I'm just trying to think how to sort of elaborate on that. People are more interested. People are more interested in how energy is developed. People are more interested in the cleaner air. Say, for example, living in northeast London, I have noticed how much cleaner the air has been in the last few weeks. I live underneath one of the Heathrow stacks. I am I'm a bit bemused because I don't see planes in the sky anymore. The clean air, I think, has perhaps helped people understand a little bit about the effects of pollution. So I think, yes, people will be a little bit more conscious about air quality. And I think people will be more conscious about sort of medicine as well. And there's certainly there'll be medical stocks that will benefit from this. Unfortunately, it's a bit of a lottery as to how it pans out and what happens there. But yes, I think people will become more health conscious. But I think also people will drive less. People's behaviour will change. People have got used to Zoom now, and I know that certainly over the next couple of years, I'll be having fewer face-to-face meetings and more meetings on Zoom, because there's been far more easier and far more acceptable than I think a lot of people imagined it to be. And I know some older people, and not so much in business, but personally, even sort of talking to my parents, my grandmother, that kind of thing, they've perhaps had their eyes turned by this. They would have never thought this was feasible, and now it has become a lot more acceptable. So yes, there are going to be certainly changes coming around from this here. Uh, as active ESG ethical fund managers, what is your view of ETF passive strategies in the marketplace? Well, there have been a few ESG focused funds out there. Um, the thing with ESG is it is quite tick box and is perhaps eventually not yet as rigorous as perhaps it could be. So you won't always get the investments you want. I think that yes, some people, there are some cheap passive instruments out there if that's what they want, but I think they have to gauge their clients very carefully that that's what the clients want. Because the most important thing here is that when you open up a client's expectations that what you're going to invest in is good, you have to meet those expectations. In other words, you can't just hope that they've got ethical investments. You have to probably make sure, because you've opened a tin of worms with a client to a certain extent, and the client expectations are that you will be looking for the right kind of investment. So I think passive has got some place to play, but I think also at the same time, in a world where stewardship is increasingly important, where people are once again asking the questions, as shareholders, we do own these companies, therefore we do need to have a say in how they're run. I actually think that this will favour a more active approach in the future. We'll see, I think, as this year pans out, how well active has done against passive, because I think probably there's more of an opportunity here for a little bit of a redressing of the sort of passive only argument that has been going on for some time. There was one more, hold on. And is there anything we can draw about how sustainable strategies have reacted? As I think I mentioned early on, I think it has been far more positive. Partly because, again, the sectors that have been hit have tended to be sectors that we would avoid, i.e., fossil fuels, airlines, large banks, and therefore, therefore, to a certain extent, we have gone unaffected. Saying that, some ethical areas have been very badly affected. Public transport has been very badly affected, so the public transport companies have been hit very hard. Microfinance has been very badly affected. Insurance has actually been quite badly affected in this process as well. So it hasn't been immune. Some ethical sectors have been hit very hard. Others have sort of been relatively unaffected by what's going on. Some have bounced back and are even, ironically, better off afterwards, particularly if they were getting, particularly social housing, for example, because I think, the government issues there have been cleared up, the money's coming. So it's interesting that it has reacted, but we are again seeing it being less volatile, and we're seeing as a result a little bit of outperformance right now. And as I hope I've answered in this seminar, I certainly feel that normally at this stage the risk we'd be considering is going to be, are we going to underperform in any bounce? At the moment, I see that as less of a risk. I think actually there's still actually an opportunity for ESG to continue to perform as well or better on the way back up. That's all the questions. So thank you very much for your attention. On the bottom of the slide there is Peter's details. So if you have any questions, please feel free to contact him. Thank you.
I'm Ben Nelms, Head of Public Policy at the UK Sustainable Investment and Finance Association, and I'm going to give you an update, a whistle-stop tour of the latest developments concerning sustainable finance in the EU and the UK. For those of you who don't know, the UK Sustainable Investment and Finance Association is the UK's membership body for firms and individuals in finance who share a commitment to sustainability. Our 240 members include asset managers, asset owners, banks, insurers, service providers, and individual financial advisors. To find out more about us, go to uksif.org. I'm going to spend most of my time today talking about developments in the EU, where we've seen the most significant efforts by policymakers to make sustainable finance more mainstream. The UK government is also very interested in sustainable finance. However, they have been a bit more reluctant than the EU to pass legislation making it a mandatory part of all finance, which is essentially what the EU have done. And so today I'm going to cover some of the key elements of the EU's Sustainable Finance Action Plan, the taxonomy, the eco-label, the disclosure regulation, and a few other bits. All three will be important for advisors in the coming years, whether you're advising retail clients or institutional clients. I wanted to start by saying something about how the EU has approached sustainable finance and why they care about it. The key thing to understand here is that the EU sees sustainable finance as a way to help solve environmental problems. The EU wants to make the European economy more sustainable, and in their view, achieving that objective will be very capital intensive. It will mean building more wind farms, more recycling facilities, changing production methods, and therefore installing new expensive plant. They want to mobilise capital to flow into projects that support sustainability objectives. This is not about making it easier for financial services to give clients who care about the environment what they want. It is about using financial services to solve primarily environmental problems. That is what the EU thinks sustainable finance is. But of course, when we look at the landscape of sustainable finance, we see a plethora of different terms, ideas, and approaches. Responsible, ethical, sustainable, environmental, climate risk, social, governance, all of these different things. So when the EU set up a high-level expert group which first looked at this in 2016, they decided that job number one was to create a common language of sustainability that finance could use, a taxonomy. The EU also saw the need for legislation in two other areas. A new piece of legislation sets out new disclosure requirements for financial market participants and financial advisors, and I'll be saying a lot more about that later. And there's also a new piece of legislation establishing common standards for benchmarks relating to climate change. I won't go into detail about that today. So let's start by taking a look at the taxonomy in a bit more detail. The taxonomy is a list of economic activities with performance criteria which relates to their contribution to 6 environmental objectives. And the 6 objectives are climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, and protection of healthy ecosystems. And it's important to remember that the taxonomy is a list of economic activities and criteria. It is not a rating of good or bad companies, nor is it a list of things to include or exclude. Also important to remember is the fact that activities which meet the criteria are sustainable, but those which do not meet the criteria are not therefore unsustainable. Provision of French language courses, for example, is not included in the taxonomy, but that does not mean that the EU thinks these are unsustainable. The taxonomy's 600-odd pages of criteria cover sectors that the EU believes are likely to be the most relevant in the transition to a more sustainable economy. And so we have technical criteria for activities such as the generation of electricity from geothermal power. The taxonomy sets criteria for whether this activity would make a substantial contribution to climate change mitigation. And the key criteria on that one is, does the electricity generated have a life cycle carbon intensity of less than 100 grams of CO2 equivalent per kilowatt hour? If so, it's in the taxonomy. If not, it's not in the taxonomy. And how does the EU envisage this being used by investors? Well, there's basically 5 steps. First, identify the activities conducted by the company, issuer, or covered by the financial product, for example, in the case of project finance. Second, for each activity, assess whether the company or issuer meets the relevant criteria for a substantial contribution. For example, does the electricity generated have a carbon intensity less than 100 grams of CO2 equivalent per kilowatt hour? Third, verify that the various do no significant harm criteria attached to each economic activity are satisfied. These criteria are there to ensure that an activity which reduces CO2 emissions but which has a terrible local biodiversity impact cannot be classed as sustainable. Fourth, conduct due diligence to avoid any violation of the social minimum safeguards stipulated in the taxonomy law. Again, it's no good to have a wind farm that runs on child labour. Fifth, calculate alignment of investments with the taxonomy and prepare disclosures at the investment product level. Every fund manager will have to assess their fund's alignment with the taxonomy and publish it, or they'll have to publish a statement saying that the fund was compiled without considering the EU Sustainable Finance Taxonomy. And the chart we have on the screen here shows how you can, with taxonomy-aligned data about companies and their activities, for companies A, B, and C, derive a rating for your investment portfolio. So company A derives 40% of its revenue or turnover from sustainable economic activities. Company B gets 80% and company C only 10%. You then weight each company according to the number of holdings in the fund and calculate the fund rating. There's also a taxonomy-based EU Green Bond Standard for green bonds, which I won't go into detail here. And this, in a nutshell, is the taxonomy. And why does it matter? Well, for 2 reasons. The taxonomy is going to become a vital tool in determining the greenness of a product or service in the future, and also potentially whether or not a product will meet your client's needs. One of the ways in which you might end up using the taxonomy is through the EU Eco-label. The Eco-label already exists for a wide range of products and services, dishwashers, microwaves, that sort of thing. It marks out the best 10 to 20% of the market in terms of environmental standards. And the EU expanding that to financial products and services as well as part of the action plan. That's a fairly lengthy process which consists of a lot of testing of criteria levels, but they aim to have it finished by around mid-2021. And there's a focus very much on retail financial products with the Eco-label. The EU are currently proposing 5 criteria to determine what funds get the Eco-label. The most important is the first, the investment in green economic activities. It will essentially consist of a weighted average of the portfolio that is taxonomy aligned. If we think back to the slide we saw earlier about how to use the taxonomy, the Eco-label's criteria will set a minimum threshold on the level of a fund that must be compliant with the taxonomy, with some thresholds on company level too, to prevent the worst companies from getting into an Eco-label labelled fund. Then there are other criteria with exclusions relating to the environment. For example, no more than a few percentage of the portfolio can be exposed to coal mining, and minimum social standards as well, so that no companies can employ child labour. Criterion number 5 may be of most interest to advisors, as it requires information to be given to the end beneficiary about the share of the assets under management in taxonomy-aligned activities, how the fund manager engages with companies, the type of exclusions considered, the main principles govern the selection of companies, and other information about the fund's composition as well. And funds carrying the eco label will generally be providing a huge amount of information to the clients, which advisors may have to interpret and explain. We come now to 2 bits of EU regulation which will directly affect advisors. At first, there's a very small amendment to the KYC process established by MiFID II, the suitability assessment. Advisors will have to canvass their clients' views on sustainability issues, incorporate them into the selection and recommendation of products, and then report back to clients on how their preferences have been incorporated. But more significantly, there's also the new EU disclosure regulation, which is a new EU legal act that creates duties on investment managers and investment advisors relating to the sustainability information that they have to disclose publicly and to their clients. The regulation will generally apply from the 10th of March 2021. That date is significant when we think about Brexit, and I'll come back to explain why later. Broadly, the regulation seeks to lay down harmonised rules on transparency with a view to promoting the integration of sustainability risks into investment processes and the disclosure of such risks to investors. The regulation defines a sustainability risk as an environmental, social or governance event or condition that, if it occurs, could cause an actual or potential material negative impact on the value of the investment. Under the regulation's provisions, financial advisors will be required to publish on their website how they integrate sustainability risks in their investment advice. Investment advisory firms will have to publish whether they consider in their investment advice the principal adverse impacts on sustainability factors of investment decisions. Advisory firms will also have to publish how their remuneration policies are consistent with the integration of sustainability risks. And there are also new requirements for pre-contractual disclosures. Advisors will have to include descriptions of the following in their pre-contractual disclosures: the manner in which sustainability risks are integrated into their investment advice, and the results of the assessment of the likely impacts of sustainability risks on the financial products they advise on. Where a financial product promotes ESG characteristics, the disclosures must include how the product meets those characteristics, and whether and how any benchmark index referred to is consistent with those characteristics. That concludes our overview of the EU regulatory and legislative landscape, which is becoming increasingly focused on ESG and sustainable finance. I want to just make one comment on Brexit before we move on, which is that the extent to which UK firms will have to comply with any of these new EU rules remains unclear. The UK is currently in a transition period on its way out of the EU. EU law still applies in the UK as though it were a member state, but after the end of the transition period, which is currently due to conclude on the 31st of December this year, any EU laws which come into force after the 1st of January will not automatically apply in the UK. Most of the action plan's legislative elements are due to come into force from 2021. It's looking more and more likely that the coronavirus pandemic will force the UK to extend the transition period, and the withdrawal treaty provides that this can happen for a period of 1 or 2 years. But until that happens, firms cannot know whether these new rules will apply to them. If they are selling into the EU, it's a fair assumption that they'll have to comply with EU legislation. If they're not, then it's less clear. The UK government has been equivocal. In June 2019, Theresa May's government said that the UK would match the ambition of the EU Action Plan on Sustainable Finance. But Boris Johnson's government takes a tougher line on adhering to new EU standards after the end of the transition period. So will the Treasury and the FCA have to legislate to make a UK version of the Action Plan? At the moment we don't know, but I would say it seems highly likely. I'll finish now by saying a bit about the UK landscape. The UK government has not produced a package of measures as broad or comprehensive as the EU, but ministers take a very strong interest in sustainable finance nonetheless. Most of the UK attention is focused on climate risk and pension funds. The UK's leading role in setting up the Task Force on Climate-Related Financial Disclosures, or TCFD, makes it a natural favourite of ministers. Its climate focus also fits with the UK's own focus on climate change ahead of the delayed COP26 UN Climate Summit in the UK next year, and the UK's recent commitment to reduce carbon emissions to net zero. So we have various things underway. The FCA is making new rules to encourage, but not force, premium listed companies to disclose how they're managing climate-related financial risks in line with the standards drawn up by the TCFD. But more significantly, the UK government is legislating to require large trust-based pension schemes to make TCFD disclosures, and that will be mandatory, not comply or explain. We can expect the FCA to do similar things for contract-based schemes. This follows recent new rules that the FCA made last year, coming into force this year, for contract-based schemes to develop a policy on how they manage financially material ESG risks. Taken together, all of these new obligations are going to require trustees and their investment managers to significantly increase how they manage climate-related risks. Increasingly, they'll be turning to their advisors for help developing their investment beliefs, developing their policies, and asking for tips on how to engage their asset managers and produce a good TCFD report. And I'd encourage you to look at the DWP website, that's the Department for Work and Pensions website, for their consultation on draft guidance to trust schemes on how to implement TCFD. That's running until June. In the meantime, if you have any questions, please do get in touch, and thank you very much for listening.